Hi, it's Brian Decker with your Market Minute. Last couple of weeks, we've talked about charitable remainder trusts and using those to sell low cost basis stock, to sell real estate, and to sell a company paying zero capital gains. This is awesome. And then if you put X in, you pull 3 or 4X out in taxable income. I know it's taxable, but anyhow, we're able to save significant taxes in two ways. One, you pay no capital gains, and two, you have a credit that allows us to move and offset an IRA transfer to a Roth and pay zero taxes, and then you've got the benefit of that growing tax-free and distributing tax-free income. That's what we've talked about the last 2 weeks. Today we're going to talk about donor advised funds. Donor advised funds is when you don't have anything to sell for a capital gain, but you desperately want to have tax credits because you just want to offset some of the taxable income that you've got. If that's the case, a donor advised fund transfers money outside of your estate. So typically we would take advantage of charitable giving. So if you give to a charity or your church every year anyhow. I just talked to a client last week. He gives about $30,000 a year to his church. So what we did is we took 30,000 times 5, so that's 150,000, and put it in a donor advised fund to pay out for the next few years on schedule like he always does. But then he got a credit, a tax credit that he can use to lower this year's 2021, this year's taxable income for himself. So he had a big year, wants a tax credit, and that's how we generated it. The second benefit is he's in he's got large assets, so he's worried about estate taxes, and so here's a way to transfer money out of your estate and get a tax credit. So that's how we use the donor advised funds with our clients. We've got more to come on other tax strategies that I'll be talking about next week. Have a good week.